So Rocco is a long-term member of our group. He's works with SAS here in Cary, Raleigh, North Carolina, Raleigh area. But more than that, and separate from that, he's an options educator and an options researcher. He delves into the theoretical side or the research side of options, but also into the very practical side of trading. Some of our recent meetings, people have said it might be good to separate into an introductory session and then a more formal session or a more advanced session. But hopefully people will stay. I mean, I think you'll find that even if you're on the introductory side, you get something out of the more advanced presentation that comes a little bit later. But for now, I'll just hand it over to Rocco. Please go ahead, Rocco.
Thank you, Don, and thanks everyone for joining. Let me just start opening up with the content. So today we'll cover a number of topics, primarily around the concept of the volatility skew and the term structure, and how the volatility is how the skew is actually affecting our positions, and how do we potentially model it, and how can we take advantage of the skew whatever is there. So the first part is more introductory, as Don was saying. The second part is more of a research piece, and includes kind of a new Greek that I kind of call Vega skew because I kind of ran out of ideas, but happy to take suggestions. So before we start, I will not spend much about myself. Just I'm showing this slide because you can find my email address where you can contact me if you want to ask any questions going forward. So I'm not going to talk about myself. But before we start, obviously, I need to talk about the disclaimer. I'm not a financial advisor. So trading involves risks. So you have to you're encouraged to consult your own financial advisor before you take any trades. Whatever you see today is all about it's for education purpose and should not be construed as a financial advice. All right, so we can start. So let's start from the basics of well, we have an option, and how do we value an option? So there's different ways you can price an options. There are different models, but in essence, you can kind of think of these as a black box with a couple of levers that you turn those levers, and an option price is coming out of this model. And there's the Black-Scholes is probably the most famous models, but there's also additional ones. Now, what are the parameters? Typically, to price an option, you need to have a number of parameters like the time to maturity, so how long this option is going to last before it expires, what is the spot price, what is the implied volatility, and that's what we're going to focus about today. The strike price of the option, obviously the type, if it's a put or a call, and the basically dividends and interest rate. So actually, sorry, the time is the time right now, and the expiry is when the option expires. The most important ones are the three ones that I'm showing here. So the time, basically the time that is left, the direction, which is basically the delta, how the underlying moves, and the volatility. These are the three most important parameters. The other ones are also relevant, but they don't necessarily have a huge impact on during the life of the trade of an option. So to get to some of the topics which we're going to talk about later, I'm going to talk right now about well, we have to kind of start introducing what the Black-Scholes model is. And I promise you, this is not a financial, it's not like a finance lecture or anything else, but I want to cover some of the basics, and I'll try to explain as simply as I can, like what's behind the pricing of an option. So we have this kind of strange looking formula where C is the price of a call, and we have a number of parameters, and I'll try to explain what all of these parameters are. So the first piece is basically a discounting factor. It's used to it's the concept of time value of money, that if I have $100 today and the interest rate is 5% per year, it means that this $100 today will be worth $105 a year from now. In this case, you see a minus sign here, which basically is the opposite, meaning that if I know that I will receive $105 a year from now, and the interest rate is 5%, then that means that the value today of that amount that I will receive in the future is $100, right? So this discounting term is basically used to bring back the value and calculate what the present value of a particular price is. Then we have two components. F is the forward price, which is the future price where we expect the spot, the underlying to be. We also have, well, F actually, obviously there is the S, which is the spot price, and the R is the interest rate, and Q is the dividend. As indexes like SPX don't pay dividend themselves, but most of the equities usually pay a dividend, so it needs to be accounted for it. And then we have the K, which is the strike price. So in a super simple form, if we look at how a call or an option behaves at expiration, it's basically the difference between the value of the underlying at that particular point at expiration minus the strike price. If the underlying is above the strike price, I make money. If it's below, the option obviously expires worthless. So the difference between these two, F minus K, it's going to be the value of my option at expiration. But before things expire, I need to take into account what is the probability that the option is actually going to be in the money, right? And so these terms need to be basically this F and K, they need to be multiplied by some probability. So this phi of D1 and phi of D2 are essentially two different probabilities. So let's start with the phi of D2. This is essentially the probability that at expiration, the option is going to be in the money. And phi of D1 is, it's usually a little bit more complicated to understand, but essentially it tells us what is the, when I look at all possible values that the underlying might have in the future at the time of expiration or at any point in time from now, I need to look at conditionally on the fact that this underlying, for me to make money, has to be above the stock, has to be above the strike price. So this phi of D1 represents a conditional probability that is used to calculate the expectation, to calculate what is the expected value of the spot price that at a particular point into the future. So it's a little bit complicated, but typically, essentially, when you actually look at the Greeks, this is nothing else than the delta, and that is the reason why delta, which is again is also a probability, it's typically used as a proxy to calculate what is the probability of actually going in the money. But the real probability is not delta; is actually a different one. Now, why do we usually use delta as a proxy instead of using the real one? Well, obviously because delta is right there on the platform, and if I can show you these two graphs. Basically, this phi function is the chart on the bottom, and which represents the cumulative normal distribution function. And the derivative is basically nothing else than the normal distribution function. So this is the typical Gaussian function that it's very, very common in finance and actually pretty much everywhere else. And so D1 and D2 represents these two levels on which we are going to calculate probabilities. And typically D1 and D2 are actually fairly close enough. And that's the reason why we use the delta as a proxy to calculate the actual probability, because the two values are fairly close to each other. Again, it's not an exact approximation, but it's fairly similar. So what is the one and the two? I mean, here's the formula, but essentially sigma is the implied volatility. Tau is the time to expiration. It's expressed in years. So if tau equal to 1, basically means it's 1 year from expiration. And then with this ratio here of S over K, which is basically the moneyness. How much are we in the money? If it is a call, S is the spot price, K is the strike price. If the spot is above the strike price, so if this ratio is above 1, we are in the money. If the ratio is below 1, we are out of the money, right? So this basically measures how much are we in the money or not. So why am I showing you this? Because if you look at how in all of these formulas, whenever we see sigma, which is the implied volatility, it always shows up multiplying the piece, which is the time piece. Okay, so we have sigma times the square root of time, or here we have sigma squared times time, which is basically everything squared, right? So either way, in this formula, you see that the volatility piece and the time piece are always kind of going hand to hand and in end. And so, and that is why time and volatility have similar effects when it comes to option price. And I'll explain a little bit more in intuitive way what's going on here. So if you look at these two charts, we have this chart is showing you an at the money put, what would be the theoretical value. And on this, on the x-axis, we have the time to expiration going from, let's say, 100 days to 0. And then on this y-axis, we have the implied volatility. Okay. So essentially, when you see, and this is kind of the colors here is, if you follow this, the color on the three-dimensional graph is basically showing you all of the points where the price of an option is always the same. So if I'm looking at this yellow color here, which tells me that the price is $161, then if I follow this yellow color anywhere where I am, it tells me that all those combinations of expirations and implied volatility lead to the same value of the price of an option. So, but another important aspect of all of this is that essentially, if you look at this chart, if I add time, as you can see, we're going from 1 DT to all the way to 100 days to expiration. As we add time, the price of an option increases. So so does when we increase the volatility. So whether we increase the volatility or whether we increase the time, essentially the price of an option increases. If we decrease the time or if we decrease the volatility, obviously the price of an option decreases. So these two things basically act in a similar way. However, they don't act with the same strength. And I'll show you in a moment how much of a power time has versus the actual volatility. So a typical thing to consider is that if you are especially trading, for example, 0 DTs or well, if you're actually, let me rephrase it. If you're actually trading short term, not necessarily 0 DT, and you are in a low volatility environment, what happens is that obviously when you have low volatility, your strikes are very close to the money. And so a way to try to kind of artificially increase the volatility is to basically go out in time a little bit more, because by going out in time, it's like if you are adding volatility. Again, it's not exactly the same thing, but it's the effect is kind of similar. Now, how similar are these two effects? Well, here's a formula that it's a bit of an approximation, but it's fairly accurate. What I'm showing you in this chart is, imagine that you have sold a short put at 60 days from now, okay? And so the volatility is whatever the volatility was in this particular example is 20%. So let's assume that let's say that we sold the short put 60 days from now with a 20% implied volatility. Now, obviously, this put is going to have a price. What this chart is trying to calculate is, well, if the implied volatility increases by 1%, obviously the price of this put is going to increase, which means that I'm going to suffer, right? Because I sold this put, so obviously I don't want the volatility to go up. So what this chart is showing you is that if the volatility increases by 1%, essentially it would take 5.58 more days for that put to basically, for the theta, for the time decay of the put, to go back to where you were when actually you sold the put, where before the volatility increased. So this is showing you how basically every single 1% in increase in volatility or decrease, how many days is going to add to you. So how much time is basically burning that you're going to have to wait before you get back to where you were before the increase of the volatility. And as you can see, the higher the volatility, obviously it adds a lot of days. And on the other hand, if the volatility collapses, you can quickly take a profit, because as you can see, this is not a linear increase. It's a nonlinear increase. As you can see, it basically goes with the square root of time. And so this chart is to show you that the volatility is much stronger than the time itself. And sometimes even 1% increase in volatility it means that it can burn you a lot of days of waiting, hoping for your options to decay. So it's kind of important to understand this concept. So here's a simple formula you can use to calculate how many more days you will have to add or reduce depending on whether your volatility is increased or not. So you plug in your how many days was the original the DT is the obviously the days to expiration of your original option, let's say 60 days in this case. Sigma is the volatility of when you open the trade, or for example today, like so let's say 20%, and then assuming 1% increase, that's the value you plug in this formula at the bottom, and it's gonna DT change is how many more days you end up having to wait to get back to even. Okay, and obviously this formula does not take into account the interest rate change, which changes a little bit the results, but fundamentally it's for all intents and purposes it can be kind of neglected in here. All right, so now that we understand a little bit more about the concept of time, volatility, and how do they operate with each other, let's talk a little bit more about the skew and why is there skew. So when Black-Scholes came up with their model, they assumed that the volatility will be constant. So if you actually look at the formula of that I showed you at the beginning, there's only one value, sigma, which is assumed to be always the same and constant for a particular underlying. But the reality is that this assumption obviously is not true. And if you ever trade an option, you know that the implied volatility changes with the strike. It changes with time. So there's a lot of different volatility that we have to deal with. So what's going on with all of this? Well, and most importantly, why do we sometimes see that strikes that are equidistant from the money? In theory, one would think that they have the same probability to be reached. And if that's the case, then why is a put at that strike more expensive than an equidistant call on the other side, from equidistant from the other money? So what happens here is that in following the market crash basically of 1987, the reality is that market makers and everyone realized that people tend to overreact when there's a crisis, and they want to be paid more for taking the risk, because usually when crashes happen, then obviously the market crashes very quickly. When the market goes up, it goes usually kind of a slower or slow grinding up. So essentially there is an asymmetric effect between when things go well and when things go wrong. And so for that reason, essentially if those who are selling put, they want to be compensated for the risk that they're taking. On the other hand, because many people usually are not necessarily option traders, but a lot of normal people that do trading, they actually are long the stocks. So they're buying stocks, they're buying indexes, they're buying ETFs, and they want to have a way to protect themselves. So what happens is that obviously to protect yourself, the simplest way to do it is to buy a put on the S&P, on the market, because if the market goes down, at least you get the protection from the put. So this essentially creates an increased demand for buying puts, and obviously when the demand goes high, so does the price. So the higher the demand, the higher the price, which means that implied that the price of options for puts is increased. And essentially, if we look at the Black-Scholes formula, in this particular case, if the underlying is not moved and the time is not changed and nothing else has changed, to justify that price, the only thing that is left is the implied volatility. So implied volatility is basically this unknown variable that we have to change to explain why are we seeing the price that we're seeing in the market. And so since the price of puts is higher, especially for out of the money puts, due to this high demand, that means that the implied volatility of those puts is actually higher. On the other side, what typically happens is that to finance the cost of buying this protection, hedge funds or maybe individual traders also, they go and sell a call because that helps basically to finance some of the costs. So they're willing to give up some of their potential upside profit, but in order to reduce the cost for buying the protection. And so this essentially creates a higher supply of calls in the market. So if everyone is selling calls, then obviously the price of a call goes down, which means that, again, by the same argument, the implied volatility of those calls is actually going down. So this chart is showing you this dotted line shows you the assumption of the Black-Scholes model, where implied volatility is supposed to be constant across all the strike. In reality, it tends to take a shape that looks like this, where the puts are more expensive than the calls. Now, it's not always like this. So this is called skew. And in this particular case, it's called the put skew because it's basically higher on the put side. But we also have the opposite effect when essentially the calls are more expensive than put side. So we'll get there in a moment. So how do we take advantage of the put skew? So what happens is, obviously, if I have a put and the implied volatility of puts is higher than the implied volatility of a call that is equidistant, what it means is that naked puts are actually more expensive because of the put skew. They have a higher volatility, which means a higher price. So buying a naked put is more expensive if there is put skew. On the opposite side, obviously, is if I'm selling the put, obviously it's going to be good for me because I get more premium, right? So depending on which side you're looking at this could be a good thing or a bad thing. But what happens is that, yeah, even though naked puts are more expensive, actually put spreads are cheaper. And why is that? Because if you think of a put spread, let's say the green one represents something that I'm buying, and the red dot represents a strike that I'm selling. Essentially, I am buying a low volatility. Well, I'm buying a certain level of volatility, and I'm selling a strike with a higher volatility than the one that I bought. So this higher volatility obviously inflates the price of the option that I'm going to sell, and that means that the overall cost of this spread is going to be cheaper than if actually the two had the same volatility, right? If the volatility were constant. So the fact that the volatility is actually increasing as we go far out of the money, it means that a spread is going to have a relatively cheaper price, whether you're buying or selling, compared to if there was no skew. And so again, naked puts are more expensive, but put spreads are actually cheap. On the opposite side, because there is no skew on this side, or there is a relatively little skew. So naked calls are cheap because since the volatility is not that high, it means that I can actually buy a naked call. Obviously, if I'm selling a naked call, I'm going to be paid less. But because again there is little skew, that means that I'm when I'm looking at a spread, I can collect more credit compared to a spread that I would or if I'm selling, obviously, compared to the credit that I would collect if I were to sell a put spread of same or of equal sides. And I'll show you this one on a platform in a moment, how these numbers actually play out. So but another thing to consider is that usually when traders or when hedge funds are selling calls, they tend to sell around the 16 delta range, because basically you put yourself about one standard deviation away. And so that means that that's where the implied volatility tends to be the lowest. But and eventually, as you go farther out of the money, the implied volatility goes back again and keeps increasing. So the same argument that I talked when I explained that put spreads are cheap in this section because the volatility is increasing because of the skew. There's a bit of a skew on this side as well, which means that these types of spread are also cheap. So depending on where I'm placing my strikes, if I'm buying or selling a call spread, for example, if there is a put skew, I can probably sell a call spread closer to the money and get paid more money, or anywhere where there's a fairly little skew or the volatility is fairly constant. And I can take advantage of the fact that at some point the volatility is going to keep going up, which means that I could potentially buy a spread in that zone because that's where it would cost me less money to buy. So in general, what are types of trades that take advantage of this skew situation? As I was saying, obviously buying a put spread, it's cheaper to do it when there is put skew. and so is buying a very farther dated, farther out of the money long call spread. Also, selling short call spreads, it's more convenient because I can collect more credit, or I can also there's two types of trades which are actually very common. One is called the risk reversal, which is basically buying a put spread and selling a call spread to finance. So it's obviously it's a bearish type of trade, and I'll show you this one in a moment on the platform, where basically we are buying a put spread, thinking that the underlying is going to go down, and we are financing that cost by selling a call spread. And typically, the credit that I will be able to collect from the call spread is more than enough to cover the entire cost of buying a put spread on the other side, even if you place the two at the same equidistant. There's also another trade called J Lizard, which is basically leverages the fact that short puts are more expensive when they're naked, and when there's a high skew. So I'm taking a lot of credit by selling a short put, and I'm also adding additional credit by selling a short call spread because of the fact that there's a low skew on the right side, and so that means that this spread is going to be quite rich, quite a lot of premium. And if this trade is set up correctly, you have basically no risk to the upside at all. You just have some, obviously, you have risk on the downside because you have a short position, a naked position on that side. So let me just switch a second to show you maybe these type of trades on a platform, so it may be a little bit more easy to understand. So I'm going to stop sharing here, and looking for my Thinkorswim application that there is. So what I did here is basically if you open S&P, SPX, or SPY, any of these instruments where there is put skew, what I did is look at a put spread of $5 wide, so the 545, 540, so it's $20 out of the money in this case. Again, this is not a trade for you to replicate; it's just a trade to explain what it looks like. So we're going 20 points out of the money, and I'm buying a call spread. And the cost of this, I'm buying a put spread, and the cost of this put spread is $1.85. Then we're going 20 points out of the money on the call side, so the strike 50.85, and we're buying a $5 wide call spread, which is we are selling a $5 wide call spread. And as you can see, the price of this call spread is actually $2.25. So the credit that I'm receiving for selling this call spread is enough to cover the cost of the put spread, and plus some more. I have some extra 50 cents or whatever. So if I go and look at the risk profile of these two, so obviously I have a put spread on this side, I have a call spread on the other side, and as you can see, that in this zone where the zoom in a little bit, maybe you can see it better. As you can see in this zone, where the flat line is there at expiration, obviously this is the credit that I'm receiving. This is the 20 to 40 cents extra that I'm receiving in case if the underlying doesn't even move at all and stays within this range. So when would you put a trade like this? This type of trade typically is done when you're reaching kind of the all-time highs, or when the market is going high quite a lot, and you may think that it might bounce back and reverse for a while, or because it's kind of oversold, and it's kind of overbought. And so for that reason, you might want to consider a trade like this, that where you want to basically be delta negative, you want to be bearish, and you take advantage of the fact that there is this put skew to actually place yourself in a position where it would be much more advantageous for you because of the fact that the skew is helping you with the price. I also talked about the J Lizard. This is a trade that is for those of you who maybe followed tested trade, they talk a lot about this trade. I think it was Liz and Jenny, the two hosts of the show, that came up with this trade. So long story short is, what I'm doing here is selling a short put. So let's say I'm gonna pick one short put here, and then I'm going to also sell call spread, but maybe I'll take this a little bit. I'll go maybe delta 16, or to give myself some room. So I can we can go here to delta 16 and sell a vertical. Also, maybe if I'm selling a put, I may want to go a little bit lower than 26 delta. So maybe let's go at delta, let's say 16 delta. So that would be strike 4975. So this would be the risk graph that we combine. So what happens is obviously we get the premium from the put, but we also get a premium from the short call that we're selling, and obviously you can play with the size, the width of the spread. But the whole point of this trade is that you want to have zero risk on the downside. So even if your short strike, even if your short spread is actually if the underlying goes above your short spread, if it's completely in the money, you're still making money anyway, because of the premium that you collected is more than enough to cover the entire risk associated with that, with the downside of that spread. So this is one trade. Again, this is one example where we are leveraging the fact that there's a high skew on the put side, so we're selling a naked short, and we are selling a put spread because there's a relatively flat implied volatility curve on this area when we're selling on the call side. So going back to the slide deck. Right, so on the call skew is basically the reverse effect. And why does this happen? Typically, this happens on the equities, and that's because, well, obviously, some equities, some people are more bullish and they want to buy a lot of these of calls because they think that the underlying is going to go up. Take the GME example, take the AMC, take a lot, or Nvidia, or any of these stocks where there's a lot of demand because people think that the stock is going to go up. Obviously, it's going to increase the demand for calls, which in turn is going to increase the implied volatility of those calls. And same story, to finance the cost. People tend to sell puts because they don't believe that, or they think that the stock is going to go up. So selling puts is a way also to be bullish, and at the same time is going to give some credit to pay for that cost. So that's where you end up having a situation like this, where the skew this time is on the call side rather than being on the put side. And obviously there's all kinds of variation. You can have a full, it's called a volatility smile, when the skew is symmetrical on both sides, or we talk about put skew or call skew depending on which side is more pronounced. And essentially all of what I explained before is exactly the same. It's just that it's reversed. When there's call skew, the puts are individual puts are cheap and put spreads are expensive, and while naked calls are expensive and call spreads are cheap. So the type of trades that we can do is exactly the same that we would do on when there's put skew, but just on the reverse. So instead of doing, for example, I showed you earlier the risk reversal, where we are buying a put spread and then financing this by selling a call spread. In this case, we would do the opposite. If you are long, if you're bullish, we would buy a call spread because it's cheap, and we are selling a put spread because it gives us a lot of credit. And in this case, we would have a position which is exactly the opposite of the risk reversal, the one with two spread that I showed you earlier. Obviously, you can do the J lizard in reverse, which basically means selling a short call and buying and also selling a short put spread, but doing it in a way such that overall, even if the underlying were to go down, the risk would be basically the premium you collected from the short call is enough to cover for all of the risks of the short put. So this piece kind of covers the type of skew that we can have and some type of trades that we can do to leverage these conditions. But I also want to talk a little bit about the volatility term structure, because essentially volatility does not only change across strikes, as we've just seen, but it also changes across the time. And why is that the case? Well, if you think about it for a second, is usually the more time you add to your option, the more are the things that can happen. So there's more uncertainty around what could happen to the underlying, which means that the underlying essentially could move much more than it would normally move if you were just buying, let's say, or selling an option a week from now. So because of this effect, because of the fact that the more time we add, the more the volatility, the more uncertainty there is. That means that the longer term options have typically higher volatility than shorter term option, and this is an effect that is typically known as contango. And these type of charts, you can get them from bigcentral.com. You can, as you can see here, and you can also look at historical cases. So you can put a date, and it's going to show you what was the at the money volatility term structure across multiple expiries, from 0 days to 30 days to 60 days, and so on. As you can see in the left side, we have a case where the volatility increases with time, and again, this is the concept of contango. But there's also a situation where the curve is actually completely opposite. And why would that be the case? Think about short-term shocks, like some news that come out, or maybe there's obviously if there's a war or pandemic, or some bad news in the market. What happens is that these news obviously could be reflected in the stock price or on the market index, but these effects tend to be temporary. It's something that obviously affects more the short term, not necessarily the long term. And so this causes an increase in the volatility in the fear, if you want, on the short term, for short term dated options, while things that are going to be options that are expiring a year from now or 2 years from now will feel very little of the effect of short term news. They're not say another way, and news about I don't know, bad news about Microsoft or Nvidia, it may affect for the next couple of weeks the S&P and the market, and that's obviously going to increase the volatility. But an option that is 2 years, that is expiring 1 year or 2 years from now, will kind of feel very little of that news, right? And so because of this reason, when there are shocks, these shocks are usually happening in the short term. And when this happens, we talk about this phenomenon is called backwardation, where essentially the short-term volatility is higher than the volatilities that are longer dated. Now, again, it's not always going to be that nice, where it's either all in contango or all in backwardation. There is some kind of a mix and match, right? There are some parts of the volatility term structure which are more, they are in contango, and some parts which are in backwardation. So how do we take advantage of this? Well, the best way is to basically look at temporary portions we look at essentially the term structure, and we look at areas at different expiration where the short-term expiration has a higher volatility than the longer-term expiration. So essentially, where we're looking for portions of the curve which are in backwardation. And why is this advantageous? Because we can essentially buy a calendar in that across those two expirations. Because a calendar spread, I am selling a shorter dated option, and I am buying a longer dated option. So obviously, I will take advantage of the fact that I am selling higher volatility because of the backwardation, and I'm buying back a lower volatility, which is the one sitting on the expiration behind. So by looking at the option chains, or by looking at chart like this, you can get a feel for what would be the volatility of the shorter dated option versus the volatility of the longer dated option. And if there is a condition of backwardation, that's definitely a better condition to enter to buy a calendar, because it means that you're going to buy the calendar, it's going to be cheaper than buying it in normal condition. Plus, again, the backwardation, especially if you're talking obviously about the SPX, okay, the SPY, so essentially in the market, the contango is the typical weight, is the typical behavior of the market, where when nothing too crazy happens, obviously as you go farther in time, the volatility increases. But and so if you spot some areas where there is a temporary backwardation, again, that backwardation might be temporary, which means that after you bought the calendar, maybe it's going to go back to a situation of contango, meaning that you sold a high volatility and that volatility is going to go down, and you bought a low volatility and that volatility is going to go up. So you actually win on both sides of the calendar, and that's where your calendar basically goes to profit much more quicker than it would normally do if you were opening a calendar in a contango situation. So I'll switch again on the Thinkorswim platform, because I want to show you a quick way to spot this type of scenarios. So if we go back to the option chain, as you can see here on the right side, it shows you what is the implied volatility of the chain. This is an aggregate across all of the strikes of a particular chain. So this 13.47% is the aggregated implied volatility essentially for the March 13 expiration. So we can look down this chart and see we can see that it goes up. So 11.92, 12.72. So it increases, but there may be some parts where there you go. There is an area here where the implied volatility here is 13.85, and then the next expiration is 13.27, which is lower than the one before. So this would be a better condition because there's a temporary situation of backwardation, and this is actually not by chance that it happened this way, because if you actually look at it, it happens very often across the weekend. So these two expiries are most likely, this is a Friday and this is a Monday. So usually across the weekends, the implied volatility of the Friday tends to be higher than the implied volatility of the Monday, which means that buying calendars which are 2 days apart in terms of expiration, it may be advantageous because you take advantage of this backwardation that happens across the weekend. So having said that, I'm done with this first part of the presentation. So I don't know if there are any questions from anyone or anything that is not clear you want me to maybe clarify.
Does anyone have any questions? Would you say, Rocco, that you get opportunities? Sometimes you're selling calls, and sometimes call spreads, and sometimes you're selling put spreads. Most people think of normally selling put spreads. Is it frequent that you get the opportunity to see better volatility on the call side, or is that infrequent?
So if you look at the, you mean that you see are you talking about calendars, or you're talking about the actual spreads with the skew? Sorry. So you were referring to the previous piece, right, of the skew? Is that correct? Yeah. So if you actually look at the volatility structure, you will see it very, very often on the SPX, a put skew. Now, it may be more pronounced or less pronounced, but it's pretty much there every single day. Actually, let me show you something that may help to show these effects. So I'm going to show you this Discord channel, essentially where they run this calculation every 15 minutes, and these charts here are the implied volatility curve across multiple expirations. So the blue lines, the kind of the dark color, blue and green these are longer dated color options, while the more it gets to the red, the more we are getting closer to expiration. So for example, this line here, this is the volatility curve of the 0DT. The next is the 1DT, then the next one, the 2DT, and so on, right? So as you can see, there's always this effect where left side has a much higher volatility than the right side. So long story short is selling a put spread on SPX, even though it's a very popular strategy by many traders, it's not necessarily I don't get the most premium out of this because of the skew, especially if the skew is very high like this case. You may be better off actually buying a put spread and than selling it, because if you just sell a put spread, you're gonna get very little premium, and for that premium, you're actually taking a lot of more risk. Obviously, because for a given width of the spread. So this happens pretty much all the time. Now, whether it's more pronounced or less pronounced, obviously it depends on the day. It depends on how much the market is how the market is behaving. For example, when you are in a high volatility environment, what happens to this curve is that it tends to actually flatten out. So because the volatility is so high, it's high everywhere, but the skew tends to get a little bit more flat, rather than when you are in a lower environment. Then that's where usually you see a lot of skew, and the reason for that is when there is low volatility, everyone, the market goes up, but everyone is always looking for, well, if it goes up, there may be a crash coming up soon. So people start buying more and more puts to protect themselves, especially far out of the money put, like a 5 delta, 2 delta, or whatever, all these kind of things. And that increases a lot the price of those puts. And that's why you see a very high skew, especially in low volatility conditions.
Okay, who else has a question? Well, it's a very thought-stimulating talk. Let me pause. Let me stop the recording.